Good morning.
What's up?
Well, I had a quick question. So I'm most of my savings is in ETFs and very diversified, as you were discussing. But I've had a little stash, probably 9% of my total, my total savings portfolio that has been in a stock that's been kind of volatile. It's home building. So it's up right now, and I just feel like I should go ahead and sell that. And I've sold some, I've set a price, and I've sold some of it. But my question is this. Instead of just sticking it into the existing ETFs, I'm looking and wondering if I should put it in, just a few, just 5 or so, just blue chip, dividend type stocks, J&J or AT&T, Verizon, those types of things. I've got a whole list that are, dividend producing, solid companies that whether or not the market goes up or down, the companies are going to be there. And what's your thought on that, taking a small percentage and not putting it just into the ETF?
Well, let me stop
you.
Let me stop you right there. First of all, you said that no matter what the markets do, they will always be there. Can you say Sears? Can you say Eastman Kodak?
Oh, no.
Enron.
No.
Okay, and that's the challenge that you have in picking individual stocks. It sounds to me like you enjoy that stuff, right?
Well, my background is in research in general.
Sure.
So,
that's fine.
Yeah, I do my due diligence.
That's fine. So getting back to your question about, I think you really have a question about diversification. So you have some money in the home building stock?
About 9%, I think.
Right.
Yep.
It's an individual. That's a pretty heavy concentration.
Heavy concentration.
So you probably have done well simply because of assuming it's a good company. You've probably done well in the current market.
It's growing.
Yes.
Right.
Yes. And the near outlook for that is continuing to do that as long as the interest rates are low. Right?
Yes.
Right.
So the challenge you have is, should you take your gains, what you have now, and be a little bit more prudent and get some more diversification, and there's nothing wrong with that. There's a saying in the business that the bears will make money, the bulls will make money, but the hogs will get slaughtered. And you don't want to be a hog.
Right.
So what would you suggest if Julie was sitting across the desk from you this morning in our office up in Altamont Springs, and she asked you this question, Gary?
So, Julie, what we would do, we use some software by Morningstar, and I would want to enter in your portfolio, because you've mentioned some good names, Johnson & Johnson, Verizon, etc. And if you were, say, moving 9% of your portfolio maybe to 5 or 6 stocks, and you had 1.5% in each stock, I would think that that's okay as long as you're a moderate risk oriented investor or moderately aggressive investor. I think those would be a reasonable move. I definitely think you should move away from the home building stock only because of the large amount. Now, maybe you keep 1.5% in it. But in general, when we build portfolios and we look at the underlying holdings of the exchange-traded funds, the ETFs, or the mutual funds, I don't like a client to be more than 1.5% or definitely no more than 2% in any one specific company. So I like your thought process there.